All right, well, let's get started. Welcome, everybody. Um, Thank you for your time today, talking about some exciting topics. So today, our webinar is to present prevailing wage and the apprenticeship regulations, specifically for and how they are impacting 179D, which is the tax deduction, and 45L, which is a residential tax credit. So that's the purpose of the meeting today. The format, we have about 15 slides, so I always like to know how long the presentations will be. We have about 15 slides, and we have about 30 to 45 minutes to speak today. If you have questions, feel free to either pop them in the chat, or if you have the option, you can also just ask. I want to make it as interactive as possible. Also, feel free to wait until the end. There will be a specific section designated for questions. So whichever format you prefer is fine with us. So for those of you who are not familiar with Layton, I'll give us a little bit of an intro to who we are. So Layton's an international tax consulting company, right? We are not CPAs, although we do love CPAs for all the CPAs that are currently watching. So we do not file the taxes. We just specialize in a few very technical and niche incentives like 179D, 45L, research and development, and then grants and incentives like SALT, state and local taxes. So we oftentimes partner up with CPA firms to ensure that their clients are able to take advantage of these types of incentives, right? Professional engineers, energy modeling, it's very technical in nature. So we take care of all of that, put a nice bound deliverable out to your CPA, and then they actually apply those to your returns. Okay. So we've been around for 25 years. We're an international company located in all of the major cities around the world, Spain, London. Our US office is headquartered in Boston, but we have regional offices in Phoenix, San Francisco, and Houston as well. So that's who Layton is. And today you're going to be hearing from myself and Andrea Gracia. I am a senior project manager. I've been working in this commercial real estate space for a little under 10 years now. So definitely excited to talk about some of this stuff and love delivering results. And I'll let Andrea introduce herself, then we'll get started.
Yes, thank you, Cedric. So hello, good morning, everybody. As I mentioned, my name is Andrea Gracia. I have been working in this space for about 3.5 years now, and I've had the great opportunity of delivering millions of dollars in 179D deductions and cost seg studies and 45L as well. So thank you. Yeah, thank you guys for joining us here today.
All right, so let's get into it. So without further ado, the Inflation Reduction Act is the reason why we are all having this conversation. So it changed a lot of incentives, not just 179D and 45L, but these are all of the incentives that the Inflation Reduction Act has tied prevailing wage and or apprenticeship to. So I'll let Andrea Gracia talk a little bit more about 179D and 45L specifically.
Yeah, so as you'd mentioned, there are a number of credits here, as I'm sure you guys, ITC, PTC is often discussed. But one of the huge impacts has been the energy efficient commercial building deduction. So that is 179D, just kind of shorthand. And 179D primarily is focusing on three major systems of the building when looking at identifying and quantifying the deduction. So it's going to be building envelope, interior lighting, as well as HVAC and hot water. So that's going to be determined upon the square footage calculated, multiplied by the qualifying factor. So it's going to be for 2022 and prior, it's going to be the 60 cents to $1.80. And then moving forward, there is a new amount that we can look forward to identifying for future tax savings. So that is for 179D.
Very similar for 45L. It's the cousin of 179D. So 179D is all about commercial buildings. 45L is all about residential buildings, apartments, dorms, senior living facilities, things of that nature. The credit amount is determined similarly. So there's an energy analysis that has to be taken place. That's where folks like us come in. And the amount of the credit ranges from $500 per door all the way up to $5,000 per door. So very lucrative incentives for your clients and for yourselves. So now we'll get into how prevailing wage kind of we'll define prevailing wage, and then we'll talk about how it impacts those two.
Yeah, so prevailing wage, written in the tax code, is Notice 2002-61 is going to give you exactly what prevailing wage is. So just kind of short and sweet, it's going to be the wages paid at a certain determined rate for the laborers, journeymen that are conducting the work. So this is an enforced, as obviously with the Inflation Reduction Act coming about, and this is going to affect both the new energy home credit, which is 45L, as well as the 179D deduction. And apprenticeship was put into place for 179D. So that is going to be applicable per the percentage of total hours, and that is going to be needed to be completed by an apprentice. And what an apprentice is just those who are looking at coming up in their certain field. So as you can imagine, there are multiple disciplines that have the apprenticeship, but we're looking specifically at the trades.
Yeah, so a good way to think about apprenticeship is there's kind of the classic way is like an internship, right? But there's also within these trades, there's like junior level and senior level. Oftentimes, junior level can count as an apprenticeship because they are apprenticeship under the senior level trade. So think about it in that realm. It kind of helps to clean it up. A lot of companies, what we're finding is the apprenticeship hurdle is not as high as the prevailing wage hurdle. So a lot of companies are already doing an apprenticeship for their trade. But now we just have to figure out how to document it so that way they can actually apply for it. So moving on.
So as I mentioned before, 179D is that deduction, the commercial building energy deduction. So there are a number of people prior to the January 1st, 2023 date that are eligible for pursuit of the 179D deduction. So commercial building owners, obviously with it being the commercial building deduction, are eligible. So those who own the building are able to take the deduction on the building with qualifying work. And the building or the deduction itself for the building that is qualified is able to be allocated to a designer of record. So primarily those are listed out as architect, engineer, contractor. So those who are creating technical specifications for the installation of the energy efficiencies within the building property. So with the introduction of the Inflation Reduction Act, one of the really great things is there has been a couple of other entities that have been included for allocation for the deduction itself. So tax exempt entities are now able to allocate, as well as Indian tribal governments and the Alaskan Native Corporation. So yeah, we're very excited to be able to pursue those projects as well for those eligible.
Yep.
And then on the side there's obviously government entities. Those are the ones that were able to be prior allocate, and those are just your typical prisons, airports, police and fire station houses, and then a lot of the untouched and uncovered are usually the military bases, but those are qualifying as well.
Nice. So in short, if you guys are designers or if you have clients that are designers, the 179D is very much alive. And especially for designers, for commercial building owners as well. So there's two buckets. Either you're a commercial building owner or you're a designer. Those are the two types of people that can qualify for 179D.
All right. So with the new requirements, as I had mentioned, there's going to be a little bit of an increase there. So whereas the amount savings prior was 60 cents to $1.80, If prevailing wage and apprenticeship requirements are met, the new amount will shift from $2.50 up to $5, and that is on a sliding scale. So that is with a minimum of 25% cost savings met. Now, without going too much into the specifics of that, prior requirements were 50% energy cost savings, and that was for the 60 cents to $1.80. So with the lowering of the threshold of qualification, as well as the increase of deduction value, as you can see that's, we're very excited to have that legislation inducted, as well as if prevailing wage and apprenticeship is not met, you still have the 50 cents to $1 per square foot that they're able to receive. And again, that's with that 25% cost savings. So there's definitely still information, or excuse me, you're still a deduction available for the work that's being completed. It's just now taking a different form.
Yeah. So the best way to think about this for both 1790 and for 45L is they added prevailing wage. And if you pay it, it's a 5 times multiplier. If you do not pay prevailing wage, you can still receive benefit from both of these incentives. It's just not as much. All right. So the concept here is that's why it's part of the Inflation Reduction Act, right? They wanted to make sure the trades had the opportunity to be paid a living wage or prevailing wage. But if it's not an option, or sometimes it costs more to pay prevailing wage than it does to take these incentives, that's okay, because you can still receive an amount either for 1790 or 45L. So that's an important fact that we just wanted to make sure folks walk away from this understanding. If you're not paying prevailing wage, there's still deductions and credits available. But if you are, there's more.
Yeah, absolutely. And then that is just kind of worth noting is that prevailing wage can be done retroactively. There's a number of steps that need to be taken in order to be able to do that, but that is an option whenever considering, you have a very large project that you're looking to pursue and have already started. So there's always obviously ways to go about making sure that you're able to get the increase there in the deduction. So there is a concept called the grandfather clause, is what it's known as in the industry. But it's the beginning of construction exception. So there are 60 days beginning on or after the 60 days in which the secretary has published the guidance. So that is going to be January 29th, 2023. So if there's any works that have started construction prior to that date that finish in 23, you are still eligible to receive the $5 a square foot without meeting the prevailing wage and apprenticeship requirements.
Quick question, Andrea. So what does it mean to start construction? I know you're probably about to get into that, but I'm sure there are people thinking, what does it actually mean? What is construction start date?
That is a fantastic question. So moving into that, there are two ways, aside from just kind of the normal qualification of beginning of construction, for establishing that when the project has actually began. So there is the physical work test, which means that work of significant nature has physically started on the project and has continued on. And there is the 5% safe harbor rule, which is 5% or more of the total project cost has been incurred prior to the start date. And so when they say start date, they just mean, for lack of a better word, shovel in the ground. So so those are two ways, obviously, that we're able to establish. Now, whether the work of a significant nature or whether the 5% is accrued is definitely something that needs to be discussed with a representative of 1790 in order to be able to determine whether or not that would be viable as a start. Or if that's meeting that threshold. But there are two ways that we're able to, have that information grandfathered in for it being applicable and without hitting that prevailing wage and apprenticeship requirement.
Yep. So just for some context here, if they started construction before 2023, but construction completed after 2023, and we can prove it using safe harbor or the physical work test, the client is able to take the $5 per square foot without paying prevailing wage or having an apprenticeship program. So an example, we had a client that started work. She reached safe harbor January 10th of 2023. So she incurred 5% of the overall project cost before the deadline, which is January 31st. And so she was able to claim $5 per square foot without having to meet the prevailing wage and apprenticeship requirement.
All right. So as we had mentioned prior, there were two that were affected by prevailing wage. So 45L is the cousin credit, I think, as Cedric put it here. So with the Inflation Reduction Act implementation, there were a number of things that changed for 45L. So it removed the 3-story restriction. And one of the things it obviously added prevailing wage and prevailing wage requirements for multifamily homes. But moving forward, there needs to be either Energy Star or Zero Energy Ready homes in order to look at pursuing the 45L credit. So that just kind of, as we proceed forward, we're going to go ahead and break that down into what that looks like for each, home structure. So for multifamily homes, prior to this new introduction of the Inflation Reduction Act, the highest amount that you could receive was $2,000 per unit or per door. So for 2023 and forward, if you are not hitting, if you're hitting the Energy Star qualification, but not including prevailing wage, you are eligible for that $500 a unit or a door. And then if you are able to obtain this Energy Star certification as well as a prevailing wage, in addition to that certification, you've now increased to 2,500 eligibility. Same thing for Department of Energy's Zero Energy Ready Star, Energy Ready Home. Without prevailing wage met, it is $1,000. And then with inclusion of that prevailing wage, you have now increased to $5,000. So, as Cedric said, it is a 5 times multiplier throughout. And when looking to certify for Energy Star Zero Energy Ready Home, there are several processes that you have to meet to continue forward. There are several, inspections that need to be completed and so on and so forth. So when looking at that, definitely make sure that you're looking at a credible source to be able to, apply that as we continue forward.
Yeah, there's a lot of people that are saying 45L is dead because it's now Energy Star and they think that it's extremely high standards. And it is a higher standard than it was before, but it's not dead. We have Energy Star certifiers on staff. We are currently going through the process of certifying buildings for Energy Star. It is oftentimes not as hard to reach as people think. Yeah. So I'll take this one. So we talked about on the last slide, single family or multifamily homes. Wanted to make a distinction. So for multifamily homes, prevailing wage has to be met if you want to receive the maximum credit for 45L. For single family homes, they do not tie in prevailing wage to receive the maximum credit amount. So you can see here before 2023, before the Inflation Reduction Act, it was up to $2,000. But after, if they reach Energy Star and it's a single family home, it's up to $2,500 with no prevailing wage. And if they reach Zero Energy Ready homes, it's up to $5,000 with no prevailing wage needed. So just wanted to pause and let that sink in. Single family homes don't have to pay prevailing wage. Oh, so this is kind of a hot topic in the industry, right? Is prevailing wage the same as Davis-Bacon? We'll get into that in a second. But first, let's go ahead and define what Davis-Bacon is.
Yeah, so Davis-Bacon is defined as obviously direct from the Department of Labor. It is applicable for contractors and subcontractors, but is going to be the prevailing wage provision rate, which is identified. And it assists for construction projects through grants, loans, insurance, and kind of so on and so forth. So it does play a very similar role as prevailing wage.
What I like to think about when I think of the difference between the two is Davis-Bacon is for public works projects. So if there's a funding source that's related to a government agency, right, they may have to pay Davis-Bacon in order to receive those funds. Whereas prevailing wage, as part of the Inflation Reduction Act defines it, it's not tied to public funds. So there's a bit of a difference between the two. That's the easiest and cleanest way to think about it.
Yeah. So there's a number of websites that have been released, a bunch of FAQs by obviously the Department of Labor as well as the Internal Revenue Service. And they say, is the Inflation Reduction Act a Davis-Bacon related act? And they have very explicitly answered no. So throughout, obviously, Davis-Bacon Act is a overarching group of acts that were enacted, and the Inflation Reduction Act itself is not included in that kind of the bunch, so to speak.
Yeah, so I know there's a lot of CPAs on the line, and a lot of folks that are wondering how are the two related. Again, prevailing wage, think about it more private sector, and Davis-Bacon more public sector. But if your clients or if you are paying Davis-Bacon already, there's a good chance that you are meeting the criteria for prevailing wage. It's not guaranteed, but it is very likely that because the two are so correlated and they kind of mirror one another, that if you're paying Davis-Bacon, you are very likely paying prevailing wage. But conceptually, there's just some slight differences. So.
Yeah. So, kind of obviously, can I pay Davis-Bacon instead? So, with that being very similar, that's what a lot of people are asking right now is can we meet the prevailing wage by just paying Davis-Bacon? And again, the Department of Labor has a FAQ that has come out that has basically said no. So the Department of Labor is not recognizing the Inflation Reduction Act as part of the Davis-Bacon prevailing wage requirements. And on top of that, they have, they're obviously under separate laws from the Davis-Bacon. And the Inflation Reduction Act is actually reviewed and kind of determined and taken charge of, so to speak, by the Internal Revenue Services, while Davis-Bacon is looked at and reviewed, required, so on and so forth, by the Department of Labor. So they are determined very similarly, as Cedric had mentioned. They may even meet and be qualified as the same in certain areas, counties, zip codes. All of that is necessary when looking at the prevailing wage requirements, which can be found on sam.gov. Again, all of that is out for public viewing, but they are looked at as separate by both the Internal Revenue Service as well as the Department of Labor.
Yep. Okay, so we did have a question that it was pertaining to 45L. So I think it's Vamsi. Forgive me if I'm pronouncing it wrong, but I do want to circle back to this question here in just a few minutes. I just wanted to recognize that we do have a question there, and we'll answer that shortly. So again, the Davis-Bacon Act, for all intents and purposes, is a good litmus test, if you will, for if they are meeting the prevailing wage as set forth by the IRS instead of the Department of Labor. Easy distinction there, right? One is Department of Labor, one is governed by the IRS. So let's talk about apprenticeship programs. Again, 179D, you have to have prevailing wage and an apprenticeship program. 45L, you only have to pay prevailing wage. So this slide is mainly for the folks that are interested in 179D.
Yeah, so there are a couple of requirements when hitting the apprenticeship, I guess, so to speak, requirements. So this actual visual that we have on the left was provided by the Department of Labor as to what systems can be found within your region or state to be able to obtain a apprentice. So there are some state, there are some federal, and that is the way that they are looking at having those who are constructing kind of inquire as to how to bring on aboard an apprentice. So for the requirements, there are an hour labor requirement. So the taxpayer is going to be paying for the apprentice not less than the applicable percentage of total labor hours. So there are a quantified number of labor hours that must be obtained by the apprentice in order to be able to meet that requirement. Now, as for the participation requirement, For those who are employed 4 or more individuals for the project, there needs to at least be or employ 1 or more qualified apprentices. So those are the participation requirements in addition to the hour labor requirements that need to be met in order for both, in order to qualify for the apprenticeship as laid out by the Inflation Reduction Act.
Yeah, and Andrea, it looks like, can you just kind of walk through the difference between the dark blue and the light blue?
Yeah, absolutely. So the dark blue is going to be that federal program. And so through those, that is that government governing agency in order to be able to obtain the applicable apprenticeship in that area. While as that light blue is going to be the state. So again, those are enacted by those different regions in order. No, there's no kind of, I don't want to say, database for to be able to pull apprenticeship from, but those are the ways based on those regions, whether it be state or federal, that they have programs for apprenticeship.
Got it. So basically, if you live in a dark blue state like Louisiana, it is a federal apprenticeship. So you would go to the federal offices to determine.
Right.
And then if you live in a state like Texas or California, then you would go to the state apprenticeship agency.
Correct.
Got it. All right. So the question that hopefully a lot of folks are starting to think about, like, okay, if I'm paying prevailing wage and I have an apprenticeship program, what is the record keeping? How do I prove that I'm doing these things? So
yeah. So for both, obviously books and records are required. So any person subjecting to income tax must keep the permanent books and all of this information, proof obviously of pay, proof of prevailing wage and fringe benefits, apprenticeship, reach out, all of that needs to be kept for obviously book record keeping and submitted in order to be able to obtain the deduction.
Got it. So if you are a building owner, and I think the important takeaway here is paying prevailing wage and having an apprenticeship. Let's say you're trying to claim 179D. It's not something that you just accidentally do, right? There's specific records that have to be kept. There are third parties that help obtain those through your GC or through your developer to kind of help keep those things in line. But it's just not something you could kind of like accidentally pay. Like you have to be very mindful about making sure that your subs and contractors and the people working on your building are paying prevailing wage and meeting the apprenticeship guidelines.